I would like to welcome you all to Orocobre's 2020 full-year financial results presentation. Let me begin with a summary of today's announcement and discussion of COVID-19 before Mr. Neil Kaplan takes us through the full-year financials in greater detail. As you're all aware, the lithium market has been challenging for producers over the past 18 months, and while soft market conditions persist into the September quarter, we are seeing signs of increasing volumes and some indications spots are improving. During the year, we demonstrated strong production and cost management capabilities when faced with difficult market conditions, which were further destabilized by COVID-19. The company acknowledges the need to continue Stage 2 expansion plans despite these short-term challenges. Therefore, we're undertaking an Australian dollars 120 million equity raising and share purchase plan to deliver balance sheet flexibility required to operate and expand during these volatile market conditions. The equity raise will also ensure the Stage 1 operations and Stage 2 are fully funded, taking into account capital contingencies from a range of extended COVID-19 restricted scenarios and allow us to take advantage of opportunities as they arise. We understand the importance of providing confidence and supply security to our existing customers, as well as those who we are progressing negotiations with. In this regard, we announced the completion of a non-binding MOU for long-term supply to the Toyota and Panasonic joint venture Prime Planet Energy Solutions. In response to COVID has meant that we have been adapting how we do business while supporting our communities and people. From the start, we established an emergency committee to coordinate our response to future actions. We have also worked closely with local authorities while maintaining open and transparent communication with our employees, suppliers, and communities, despite it is not being possible to meet face-to-face and with limited communications in some areas. Regular meetings of the management team had worked to implement a comprehensive biosecurity protocol, change rosters, reduce staffing, and adapt operating practices to minimize the risk of COVID infection. So far, we have been relatively successful, but are under no illusion that COVID-19 will continue to affect how we operate in our markets for some time to come. Over the last year, a weak product pricing has been the key driver of our financial results, which has seen the Orocobre Group post a consolidated net loss after tax of 67.1 million in impairment of inventory and other assets. The underlying loss was significantly less at 22 million. Despite this, the cash position of the company remains at 171.8 million with a net cash position of 44.6 million at 30 June 2020 and before completing the equity raising. Safety, productivity, and quality remain our key focus areas, and I believe safety is the foundation to improve performance. At Olaroz, the lost time incident frequency rate has improved from 3.3 in financial year 19 to 1.9. During this period of weak lithium prices, we have been working on controlling the controllable, and we have achieved a 22% reduction in costs between Q1 and Q4 financial year 2020. This has been done by reducing the number of contractors and eliminating all non-essential spend. During the year, we produced 11,922 tons of lithium carbonate. This was only 5% down from the previous year, and a testament to the improvement of operations considering Olaroz was completely shut for 36 days, including a 3-week maintenance and operating at a reduced rate of for a further 113 days to meet a subdued demand. Olaroz revenue for the year was 58 million from sales of 10,514 tons, which was achieved with an average price received of $5,520 per ton. This resulted in gross cash margin of $1,148 per ton for the year, or 21%. I will now pass on to Orocobre CEO, Mr. Neil Kaplan, to run through the financial in more detail.
Thanks, Martín, and a good morning to all. First up is the consolidated profit and loss. Lower revenues of US $77.1 million have been mainly affected by lower pricing, with an average price of US $5,520 per ton being received versus $10,322 per ton for the prior corresponding period, a 46% drop. Tons sold also reduced from 12,080 tons to 10,014 tons, a 13% reduction mainly related to the effects of coronavirus. Olaroz cash cost of goods sold of $4,372 a ton is higher than the same period in FY19 of $4,302 a ton, excluding royalties, export duties, and head office costs, mainly due to lower production volumes, the reduction in the export incentive due to lower sales, and a warranty provision to packaging costs. Over the year from September quarter 2019 to June quarter 2020, there has been a 22% reduction in cash cost of goods sold per ton. Corporate office costs reduced by approximately 24%, excluding restructuring costs. A bridge of Olaroz's EBITDAX from FY19 to FY20 can be seen in an upcoming slide. In spite of the soft market conditions, gross cash margin remained positive, $1,148 a ton, or a 21% cash margin. EBITDAX for the year was a loss of $3.9 million, which includes approximately $3.6 million related to export duties, restructuring costs of $1 million, and $2 million incurred while production activities were halted due to coronavirus. Net finance charges of $12.9 million was the result of interest income of $5.6 million being offset by net finance costs of $18.5 million related to the project finance facility, working capital facilities, interest on non-controlling shareholders' loans, and a non-cash interest expense on lease liabilities and changes in fair value. The non-cash impairment charge of $33.1 million relates to finished goods and brine inventories being written down by $18.1 million, AAL carrying value as an associate being written down by $10.3 million prior to consolidation, and other assets of $4.7 million. The income tax benefit is mainly due to the loss for the period, which resulted in an increase to the carried forward tax losses. This resulted in a statutory loss on a 100% basis after tax of $67.1 million. Moving to the next slide, this slide details the underlying profit. In move statutory loss after tax of $67.1 million on a 100% basis to an underlying loss after tax of $22 million, we have made the necessary adjustment as detailed on the slide. The main adjustment being the impairment charge of $33.1 million and forex losses of $11.7 million. The underlying loss of $22 million for FY20 is mainly due to lower average lithium prices received, higher depreciation, and higher fines at Olaroz, as well as a reduced interest income at corporate level. Moving to the next slide, this slide details the bridge between Olaroz's EBITDAX for FY19 of $54.1 million and the FY20 negative EBITDAX of $3.9 million. The main components of the reduction are related to lithium pricing of $58.3 million, reduced volume sold of $9.2 million, and Kairos restructure costs of $3 million, offset by a reduction in OPEX due to a reduction in volume of $7.8 million and cost reductions of $3.2 million. Moving to the next slide, this slide details what the consolidated balance sheet looks like for FY20 versus FY19. The key points on the balance sheet are: cash has mainly reduced given the funding of Stage 2 expansion, reduction in working facilities, and net operating outflows at SPJ. PPE has increased mainly as a result of the Stage 2 expansion. The exploration and evaluation costs have increased due to the consolidation of AAL, which has also resulted in a decrease in investment in associates. Current external borrowings reduced as a result of the repayment of a portion of the SPJ working capital facilities due to a change in Argentine regulation, while current external borrowings increased due to shareholders' loans from TTC, largely offset by repayment to Mizuho for the Stage 1 project finance loan. The outstanding principal on the Stage 1 project finance loan has reduced from $191.9 million to approximately $88 million at 30 June, and in less than 2 weeks' time will have reduced to approximately $76 million. A reduction in tax liability is mainly due to the loss for the period, which resulted in an increase to the carried forward tax losses. The finance lease liability of $28.7 million is the effect of adopting AASB 16 related to leases. Moving to the next slide, cash generated from operations resulted in a negative $6.9 million due to the substantial drop in revenues, mainly related to sales pricing and volume. Indeed, some of the main movements, purchase of property, plant and equipment, relates mainly to expansion as well as sustaining capex. Proceeds from borrowings relate to the expansion drawdown on the Mizuho loan, TTC shareholders' loans to SDJ, and a drawdown of Argentine peso working capital facilities. Repayment of borrowings is the reduction of the principal for the Stage 1 project finance loan and repayment of US dollar working capital facilities. Moving to the next slide, if we look at the cash cost of goods sold as reported in our quarterlies, we have reduced from over $5,000 a ton in September quarter to $3,920 a ton in the June quarter, a 22% reduction. This is the result of focusing on controlling the controllables, which we will continue to do. In summary, despite the soft lithium market and the virus, Olaroz continued to be operationally profitable with a positive cash margin and positive EBITDA of $5.7 million, and we continue to pay down project finance debt for Stage 1 with circa $115 million repaid by September 2020. Moving to the current quarter, this quarter will be impacted by a 3-week scheduled maintenance shutdown, and costs for the quarter are expected to be between $3,900 and $4,100 a ton. Approximately 3,800 tons are expected to be sold in September quarter, with a realized pricing of between $3,000 and $3,200 a ton. A little less than 50% of these tons were sold in July into the spot market, resulting in lower pricing with the intention of reducing inventories and ensuring cash flow. Thank you. Pass you back to Martín.
Thank you, Neil. Operating within the COVID-19 environment has its challenges, with Stage 1 currently operating with a reduced workforce and Stage 2 expansion activities slowing down given staff restrictions. We have sized our equity raising to ensure that we have sufficient contingencies and unrestricted cash to fund our corporate costs, Stage 1 ramp-up and capex in an extended downturn scenario. Additional funds have raised beyond these requirements could be used to expand the production capacity of the hydroxide plant or further develop all our resources, among other opportunities. With improving visibility delivered by build-up of our long-term customer order book and decisions regarding our product mix and expansion plans will be made with regards to needs of our customers. The management and improvement of the Olaroz Stage 1 performance remains focused on safety, quality and productivity. Despite operating with reduced staff as a consequence of current COVID-19 restrictions, plant stability and reliability has improved, resulting in a decrease of unplanned maintenance events and repair turnaround time. Plant yield and lithium recovery have also been improved. During the year, we implemented HACCP safety systems and new medical facilities. We also saw quality improvements with all product deliveries made within required customer specifications. Kaizen activities have been implemented in coordination with our Toyota team by applying the Toyota production system. Kaizen is a highly successful continuous improvement process utilized in the Japanese manufacturing industry. While it is early in the implementation process, results have been positive with a noticeable change in the mindset of our personnel. The Olaroz Stage 2 expansion will increase total expected lithium carbonate production capacity by 25,000 tons to approximately 42,500 tons per annum, of which 10,000 tons will be used as feedstock for the Naraha lithium hydroxide plant. As we outlined at the June quarter, the capital expenditure estimate is now $330 million. Key areas of cost escalation included COVID-19 related delays, more robust technology related to the carbonation process, management of impurities in the brine and soda ash systems, and improved flexibility in the liming process. With current COVID restrictions, we are aware that this project will be delayed, with first production expected to commence in financial year 2023. Over to 2020 financial year, including working on brine transportation systems, rain diversion channels, commissioning secondary liming plant, together with road and camping upgrades and new evaporation ponds. Stage 2 will result in a significant step up in capacity and consequent reduction in cash costs from $4,000 per ton to around $3,200 to $3,500 per ton. First production to be in financial year 2023 and ramp up until full capacity of 25,000 tons per annum by financial year 2026. Stage 2 volumes are expected to be fully contracted, with strong demand for both lithium carbonate from Olaroz and hydroxide from Naraha from a range of cathode manufacturers, including the PPS joint venture between Toyota and Panasonic, with whom Orocobre has signed an MOU to supply lithium hydroxide from Naraha and battery-grade lithium carbonate from Olaroz. PPS are developing a battery manufacturing business to which we will sell up to 30,000 tons per annum of lithium carbonate equivalent from a combination of battery-grade hydroxide and carbonate. The strategy will be to feed non-battery-grade lithium carbonate from Olaroz Stage 1 and 2 into Naraha to produce battery-grade hydroxide, which will then go to supply PPS. We would expect to expand the Naraha into Stage 2 to support hydroxide volumes required by PPS. At the same time, battery-grade carbonate produced at Stage 1 will also supply PPS. This MOU with PPS, along with other existing contracts, will mean Olaroz Stage 1 and 2 and Naraha will be fully contracted by 2025. Moving on to the Naraha lithium hydroxide plant. Since construction commenced, there have been no LTIs recorded. Construction activities have progressed very well, with more than 70% of planned works now completed. As at approximately $40 million have been spent on engineering, civil works, electrical instrumentation, fabrication, and procurement at the Naraha plant. Site operations have continued throughout the period. However, equipment deliveries from overseas are expected to be delayed due to COVID, which is currently projected to delay final project completion by approximately 2 months and will see commissioning commence around mid next year. We are well funded, have sufficient contingencies in place to complete the project, given total capex of $86 million, which compares to our funding in place of $92 million plus a $27 million subsidy to be received from the Japanese government once the project is completed. Neil, if you could please go with the equity raise details.
Sure, Martin. We have the equity raising to ensure we have sufficient funding to support Stage 1 and Stage 2 throughout an uncertain operating environment. There remains approximately $85 million of equity funding requirements attributable to Orocobre, which we need to spend on Stage 2, and an additional $50 million of cash will be restricted to support any unforeseen additional cost requirements for Stage 2, as well as any funding requirements Stage 1 may have. The unrestricted cash on balance sheet represents an additional contingency to weather a range of possible pricing environments and any unforeseen costs or delays that may arise due to coronavirus. In addition, any part of the unrestricted cash balance not put towards Stage 1 or 2 can also be used to fund a future Olaroz, Cauchari, or lithium hydroxide expansions. The capital raise is also positive action in response to and in an ability to deliver into customer demand as evidenced by the signing of the MOU with PPES. Thank you, and I'll now pass you back to Martín.
Thank you, Neil. On slide 23, the equity raising will be in the form of a fully underwritten institutional placement to raise 126 million Australian dollars at a 13.1% discount to last close. We will also be offering an SPP to eligible shareholders of up to 30,000 Australian dollars to provide an opportunity for all shareholders to participate in the equity raising. Here, on slide 24, we have provided an indicative timetable for placement through to commencement of normal trading and dispatch of holding statements early October 2020. Now, I would like to hand over to Tara Berry to discuss the lithium market.
Thank you, Martin. After a subdued start to FY20, several promising signs emerged between September 2019 and January 2020. The Chinese market began the year in a state of malaise, following further reductions to EV subsidization in July 2019. However, sentiment in China began to improve in November 2019 with the opening of Tesla's Shanghai Gigafactory, the prompt ramping of production to meet pent-up demand. In January 2020, the Chinese government announced the EV subsidy would be extended and provinces followed with supportive local policy. However, the accelerated spread of COVID-19 mid to late January halted early signs of momentum and further slowed China's economy. As the largest lithium demand market, China's economic situation and EV demand has had a significant impact. As a result, it is the company's view that 2020 lithium demand will be between 3 and 5% lower compared with 2019. Ex-battery segments, including glass, ceramics, and specialty products, are expected to be hit hardest as end users are strongly linked with GDP and industrial production, whereas the battery segment and its end-use markets are increasingly tied into technology adoption and sustainability efforts and can be targeted directly through subsidization as demonstrated by the EU. These factors form the foundation of strong growth expectations, driving battery segment lithium demand to account for approximately 78% by 2025. In the second half of FY20, Europe surpassed China as the largest EV market in terms of sales units. From September 2019 through to February 2020, the European EV market rallied, achieving consistent month-on-month growth on the back of more stringent carbon emissions policy. While this momentum temporarily stalled in April 2020 due to COVID-19, Europe rebounded strongly as several governments extended or increased EV subsidization by up to 50%. Beyond this financial support, Europe's long-term growth prospects have been laid down by heavy taxation on gas and diesel, dulling the impact of recent oil price declines. With these short, medium, and long-term measures, confidence has grown in Europe's battery chain development and EV sales potential. While financial support outside of Europe has not been as strong, continued reductions and bold predictions regarding battery costs suggest that price parity with internal combustion engine vehicles is in reach without the need for subsidization. This is increasingly becoming a reality through addition or substitution of unnecessary and or costly materials while still maintaining or even improving key performance traits like range and power. Economies of scale, learned efficiencies, and technical improvements have enabled cost and capital intensity reductions, shifting the EV industry closer to self-sufficiency. However, the same cannot be said with regard to the lithium industry. Technology improvements downstream have demanded tighter lithium chemical specifications adding to production costs through further purification to remove impurities. Capital costs have also been driven up by the purchase of additional purification-related plant, drawing capital away from volume expansions. While downstream timelines compress, upstream timelines continue to extend. This misalignment is expected to drive a shortfall in battery supply ahead of the overall market. Variability between lithium resources, concentrated IP, and experience is expected to limit the lithium industry's ability to keep up with demand. And now I will pass it over to Martín to conclude the presentation.
Tara, regarding ESG, at Orocobre, we recognize that sustainability must be into business, and being successful at that will lead to stronger results. During the June half, we released our third sustainability report with a significant enhancement to the sustainability section of our website. This now includes material information on how we approach sustainability across the business and performance data. Pleasingly, this focus on transparent reporting of our sustainability performance has been recognized by ASFI with a sector-leading rating. In summary, market conditions remain difficult, but our operations are making significant progress in terms of safety, productivity, and quality. We see the current quarter pricing to remain soft, but there is some improvement in spot pricing. Subject to external influences such as coronavirus, we see that demand fundamentals will have a positive impact on market conditions in the year and into 2021. Thank you, Rachel. We'll now take the questions.
Thank you. If you wish to ask a question via the phones, you will need to press the star key followed by the number 1 on your telephone keypad. If you wish to ask a question via the webcast, please click on the Ask a Question tab on the top right corner of your screen. Your first question comes from Nick Herbert from Credit Suisse. Please go ahead.
Oh, thank you, Dean and Neil and team. A few questions from me, please. I might just start with the MOU, the new offtake you've announced. The comment you made there saying that it'll minimise Olaroz' exposure to spot prices. Can you just expand on that? Whether that's referring to the hydroxide or the battery-grade carbon or the pass-through price. And then just interested in understanding how does it actually reduce exposure to spot pricing when presumably it's set with a reference to price? That's question 1. Thank you.
Yeah, thank you, Nick, for your question. The agreement with PPES will mean that we will have a long-term pricing agreement, which will be based on market benchmark prices, but will eliminate the need that we have been facing to sell into the Chinese spot market, taking whatever price was at that moment. That we have seen as one of our largest deficiencies, and this agreement should help us to improve in that regard. The agreement will not only encompass lithium carbonate from Olaroz, but will also encompass the lithium hydroxide produced from Naraha. So it would encompass both productions. The 30,000 tons will be made out of carbonate and hydroxide.
Okay, thank you. Next one, just Naraha. Can you talk through the economics of that a little more, please? You've given the cost, $1,500 a tonne. What sits below that line in terms of royalties and taxes just to get to an all-in cost? And could you also just talk to the transfer pricing broadly, so we can get to a clearer picture of what that opportunity looks like, please?
Well, I will ask Neil to get you more detail on the cost values on the transfer pricing. Now, Olaroz will be selling on market price to Naraha, and Naraha, based on a low cost of conversion, should profit from the lithium hydroxide itself into the PPES joint venture. Neil, if you have some more details on the taxes and structural costs that.
Yeah, and Nick, on specific Japanese taxes, I don't have any information at hand. We can take it offline and I can come back to you on that, but don't have specific Japanese taxation rates. Obviously, the product sold would be taxed in Japan at the company rates that are currently applied in Japan, but I don't have any other detail on that.
Okay, no worries. Is there anything else you're aware of outside of taxes that would be below that $1,500 cost you refer to?
No, I mean, there'd be obviously a non-cash, you'd have depreciation. That's exclusive of depreciation. So you'd have to include depreciation. You'd have to obviously include interest, which is very low interest rates on the facilities there. But as far as the operating cost, we'd be looking at $1,500 a ton.
Okay, thank you. And then just moving on to the price realisation and the comment that you've seen the improvement, material improvement in August. Are you able to sort of just put some numbers around that? If you were looking at that price on a similar product mix as to what has gone into your September quarter price guidance, based on what prices you're seeing in the market today, where that realised price would sit?
Nick, we're not going to get into monthly pricing. Suffice to say that July was a big tons month, as mentioned on the call and in the presentation. It was just below 50% of the forecast 3,800 tons that we're going to sell. The pricing is right down. We did take advantage of some very low spot pricing to relieve warehousing and inventory congestion, as well as ensure cash flow. So those were the two key drivers of that. So we're going to have a September quarter, which is very low in pricing. It's probably our lowest priced quarter for a very long time now. I don't know how many years, but we will step out of that in the December quarter. But certainly the pricing was a lot better than July.
Okay, thank you. And then final one, just for you as well, Neil, if that's okay. Just want to be 100% clear on the funding position now for stage 2. So you've got your 85 million remaining equity contribution, and then the reference to the 50 million in restricted cash needed for contingency. I guess two of that. One, are you comfortable that 50 million contingency would essentially cover, all of or most of the sort of the reasonable downside scenarios that you could see play out under, sustained COVID delays and pricing pressures? And two, just in terms of unencumbered cash post the placement available to stage 2, is that around that 193 million mark? So it's excluding essentially what's committed to Nara.
Right, so I'll start with your first question. The 85 plus the 50 makes up the 135 million that we've been talking about continually. Originally, 135 was earmarked as the guarantee, 75% of the $180 million loan that will be taken, that we've been drawing down from Mizuho. As we draw it down, we've got to put those funds aside as reserve funds. The point is, a month ago, as advised in our quarterly, we with TTC, we agreed that 60 million of it could also be used for stage 1 in case there are any shortfalls due to pricing, due to principal repayments to Mizuho, etc., etc. So the 85 million that are in the sources and uses of funds is basically to fund stage 2 for the various costs of CapEx, working and VAT. That's a base case you're seeing there. We then have another 50 million of reserved funds that are available for stage 2 as well as for stage 1 if there's a requirement. So that makes up the 135 million. With a capital raise, we've got in the number in there is 101 million of unrestricted funds. So in a downside case where we did stress downside cases in terms of reduced pricing for extended periods, increased CapEx due to coronavirus delays, Solays, etc. And we'll be well funded with $101 million. So that provides us flexibility, a robust balance sheet, if there is ongoing weakness in the market, as well as the uncertainty of coronavirus. Sorry, I've spoken there, Nick. I can't remember your second question.
That covered it. It was more around whether you're confident that contingency, $50 million, covered most downside scenarios, but it sounds like it does.
Perfect. Thanks, Nick.
Thank you. Your next question comes from Reg Spencer from Canaccord. Please go ahead.
Thank you. Good morning, Martín, Neil, and guys. Quite a bit to digest this morning. I'd just like to start with a follow-up question to Nick on that expected September quarter pricing. Can you maybe provide a comment on how that $3,000 or circa $3,000 a tonne figure might relate to similar quality or similar spec product in China today? Is there anything different about that material that sees that price so low relative to what I can see via various price reporting agencies?
We're just deciding who's taking the answer, Reg. I mean, basically, the low pricing. It's not to do with the material. Yes, we're competing with the Chinese market in that aspect, but it's a spot price that was taken, as I mentioned, there's no issue with the quality. It's our standard prime industrial grade. No issue with the quality. We just took advantage to turn inventory into cash and relieve excess inventory at Olaroz.
Okay, that's thanks, Neil. And then on that inventory,
Reg, we were producing at a higher rate.
Okay. Sorry, through the first half of this calendar year. Is that what you mean by that?
We're producing at a high production rate, which we then reduced to meet the demand. We were forecasting sales in the range of 13,000 tons, which ended up being only 10,500. So we not only had to reduce the production rate at the plant, but also we kept a lot of inventory that we sold down in the month of July, taking these low prices that Neil just mentioned.
Okay, that's fine, thanks. And where that inventory might stand now, remind me that inventory number at the end of the June quarter would have been circa 3,000 to 3,500 tonnes, and given your expected sales for this quarter, that should drop to circa 1,000 tonnes. Is that where we stand now?
It won't be around.
A bit more, between 1,000 to 2,000.
Okay. Thank you.
It's closer to 2,000 tons. We usually keep 2 months of sales free with an average quarter sale of 3,000, 3,500. That's it. Was slightly higher than that in the June quarter.
Understood. I might just jump across now to the supply arrangement or the MOU with PPES. Are you able to say what the split would be between battery-grade carbonate and hydroxide? And then as a follow-on question for that, clearly that supply contract necessitates potentially even a significant expansion of what you've outlined as building at Naraha. And can you maybe comment on the timing of any subsequent expansions at Naraha at this time?
Well, those things will have to be yet discussed and agreed. A significant portion of the 30,000 tons would be fed over time. So increasing our hydroxide production capacity is something that we now have to focus on and start working. Also, all of the production from Naraha will be devoted to PPES, and I said before that since the requirement of hydroxide, battery-grade hydroxide is going to be larger. We will have to expand that capacity, and we'll have to start our discussions and agreement with TTC and going forward in order to be able to meet those needs.
Okay. Thanks, Martín. And so from the capital raising then, it's a bit early to say, what capital requirements there might be for subsequent expansions at Naraha and timing from that. But suffice to say that the amount that you'd be looking to raise there may be a provision in there to cover some of those costs.
Indeed.
Okay. Thank you, guys. I'll pass it on.
Thank you. Your next question comes from Glyn Lawcock from UBS. Please go ahead.
Martin, good morning. Martin, just a little going back to the joint venture offtake, just wondering, could you maybe help me understand, are there any penalties or issues around that ramp up that you've given us? Is it a take or pay, and is from their perspective, but from your perspective, if you don't, the penalties to you? Just trying to understand, or is it just a best endeavours contract? Thanks. That's the first one.
At this point in time, it's just an MOU that doesn't have any penalties, no take or pay or delivery or pay clauses. We will now sit down to negotiate a binding agreement that will get into those type of usual terms of a commercial contract.
Okay. Do you envisage it being a take or pay that you'd like to see? In exchange, I guess you then have to promise to deliver, or will it just be a best endeavours? What do you think it could end up like, or where would you like it to end up?
Well, we envision a commercial contract. Well, I would like it to end up in a contract that will give us reliability on our ability to place a product, and at the same time will give enough flexibility to our customers to be able to accommodate their needs. So most likely, maybe a take or pay, a delivery or pay contract with the standard provisions of makeup inventory and be able to advance or delay deliveries of products so as to minimize the costs from straight take or pay, delivery or pay clauses. Take into considerations that these are companies with very good intentions, and we know each other very well. The objective of this is to improve the commercial reliability for both parties rather than to impose penalties on the other.
Okay. The second question is just the $5 million per month cash burn you quote. I assume that's just phase one. If you had to put phase one into care and maintenance, and does that include or exclude the principal repayments as well, that $5 million per month?
That is
so what that number is. What that number is, Glenn, is basically we had a look at if we shut down completely, what would it cost per month to just hold, if we had a big coronavirus outbreak or something, to shut down Borax, shut down STJ, put it into care and maintenance. Obviously, we've got our corporate offices as well as finance to pay the interest. So that's interest. The $5 million a month basically covers that care and maintenance for corporate, Borax, STJ, and interest payments. It doesn't include principal repayments.
Okay, so it excludes the principal. Okay, then I guess my next question is just, if we go back, it's only 4 weeks ago we were on a call with you for the quarterly. At that point, you would have known you'd sold volume at a very low price in July, because it was the 30th of July when we met. You'd done a deal with your joint venture partner to access restricted cash, yet 4 weeks later now we're raising money at a lower share price than what it was back then. What changed in 4 weeks? I mean, 4 weeks ago we thought we had a company that could weather the storm. You'd done a deal, you knew about the low price, and prices are now actually improving, as you said. I'm just trying to understand what's moved you to do this. Is this a contingent to get the offtake agreement signed? You need to raise money to provide more liquidity, or what's changed in your mind? Thanks.
No, Glenn, what happened is we started looking into what could happen if the current scenario continues to be longer than expected. If the upturn that we saw in August is only a month. And in that event, if COVID restrictions continue and if prices do not improve significantly, we would have been with a skinny cash company our size has to have enough enough cash reserves and flexibility. The market is evolving. We're starting to think of increasing hydroxide production capacity for this new MOU, and we can't. We have to de-risk the company, and running the short cash position is, despite it's enough to cover all needs, it's quite risky. If anything happens different from what you expect, we would be in trouble. We thought it was the right time to do it when we don't need it, and being forced to do it when you run out of cash and you're forced to take anything that it's up to you.
Thank you. Your next question comes from Rahul Anand from Morgan Stanley. Please go ahead.
Hi, Martín. Hi, Neil. Thanks for the opportunity. Look, I might start with achieved pricing, and apologies, I know it's been talked about a few times. Could I reconfirm that 3,000 to 3,200 number that's been flagged is basically assuming all primary product, and there's no battery grade in there?
Yeah, that's mainly, exactly, Raul, that's mainly prime grade product, exactly, industrial.
Okay, perfect. And then if in slide 18, there's a couple of things there that I wanted to talk about. So the first one being the stage 2 to significantly improve cash costs. So it talks about stage 1 being at 4,000 and then 1 and 2 combined being at the 3,200 to 3,500 per tonne mark. Does that sort of indicate that stage 1, $4,000 a tonne is basically the best it can do without stage 2 coming on? Or is this basically just production, and once you get to the full ramped up capacity, that this 4,000 number looks better on a standalone basis for stage 1 as well?
Well, the number is calculated assuming a mix of stage 2 fully on primary product and stage 1 moving more onto purified than what it is today, and still producing some primary depending on the needs for further conversion side. So that assumes that a production of primary from the stage 1 should increase from the current. Purified from stage 1 should increase from current percentage.
Right. So then I guess, 4,000, if I read it correctly, then is the ramped up production cost of stage 1, producing a mix of battery and primary. And what percentage of battery grade does that assume, the 4,000?
Cost that we have had this year with an average of roughly up to.
Sorry, I didn't get that, Martin. Could you say that again, please?
Well, the 4,000 is a current number, and that is based on the percentage of the 4,000 is based on the current production, and it's based on the roughly 30% fat product that we've been producing throughout 2020.
Okay, so 30%. Okay, perfect. And then the top of the slide talks about the 15,000 tonnes per annum to 17.5 by FY22. Is that sort of, can we take that as guidance in the sense that you're planning to get there, or is that a rate that you hope to achieve at some quarter or as an exit rate in FY22 for stage 1, please?
But there's a range there because it will depend on the amount of purified product that we run through the plant and certain improvements that we're doing on the plant. If we run primary product output of the plant is larger than if we run purified. The circuit runs at a lower rate than the primary circuit. So that's the hypothesis on a range of different primary and purified product outcomes from stage 1.
Okay, perfect. So, I mean, if you're doing just primary, then you can be at, or you're expecting to be at 17,500 tonnes in FY22 for the full year.
Raul, are you there? Okay, what's
15 to 17.5, Martin. That's basically your expected range for FY22. It's not an exit
yes,
rate.
We should be able to get there. Yes.
Okay, perfect. Coming back to the Naraha Stage 2 question, Martín, I mean, if we do the numbers on, where the current battery grade production is from Stage 1 and what you're expecting from Naraha, and also the flag delivery schedule.
Listen. Go ahead, Raul.
Yes.
Okay, perfect. So Stage 1 battery grade production capacity, I guess, is between 20 to 30%. And then you've got the 10,000 tons hydroxide coming on in Naraha. If you look at the delivery schedule for the potential new MOU, this would suggest that you'd basically be required to start thinking about Naraha Stage 3 pretty much in calendar year 20 to have that up and running basically by calendar year 24. So is that sort of how you're viewing this chart as well, or are there some other levers you can pull? And then how should we perhaps think about potential CapEx spend for Naraha Stage 2? Thanks.
Well, it will all depend. All depends on how the next 6 to 9 months we will devote it to transforming this MOU into an actual commercial agreement, and that would tell us a lot about the volumes and the different products that would require to meet those volumes and how the ramp up of those. Naraha would start with 10,000 tons of lithium hydroxide, which should be enough to cover the first 2 or 3 years of the MOU. After that, yes, we will plan to improve hydroxide capacity, and we will do that well in advance. If we have made any plan already, the answer is no. If we are providing to have cash to invest in that, the answer is yes, we are getting ready for that.
Thank you. Your next question comes from Bria Murphy from BMO Capital Markets. Please go ahead.
Hi, thanks for the question. Most of my questions have been answered, so just one from me. Can you talk about why you decided not to curtail production given negative margins? Is there a risk that lithium price recovery may be slowed down if capacity isn't closing even when it's loss-making?
Yes.
Sorry, Bria, could you just repeat that?
Tara to answer your questions.
Sorry, Bria, would you mind repeating that?
Yeah. So just wondering, or if you could talk about why you decided not to curtail production given negative margins in the September quarter, and then is there a risk that the lithium price recovery may be slowed down if capacity isn't closing even when it's loss-making?
Sure. So our decision was made because we were in advanced discussions with our customers to, even though it is on a spot basis, we had existing negotiations with our customers. So even with that foresight on price, we needed to continue production. In terms of price, we believe that it reached a bottom, and so the best decision for us was continue into production and fulfill those customer orders.
Okay, thanks.
Thank you. Your next question comes from Levi Spry from JPM. Please go ahead.
Hi guys. Still lots of questions, I suspect. Maybe just a bit more of a helicopter. So you said you raised enough to cater for an extended downturn sort of scenario. Can you run me through the assumptions for that, particularly given that you're also waiving the potential for another round of CapEx at Naraha Stage 2? And maybe you can talk through exactly what needs to be ironed out for the MOU to be converted into a firm contract. Is it actually firming up Naraha Stage 2? Thanks.
Oh, I don't think. Are you there, Martin? Martin's talking, but it's not coming through. There's no voice.
Sorry, I was in mute. I was telling you that there is no detailed calculation of expansion of the hydroxide capacity. We are planning that we will have to do that and start moving and spinning our wheels in that direction, and that's why part of the excess cash that is being raised in this equity raising would be devoted to that project. However, there's nothing yet firmed up. And yes, now we enter a 6 to 9 month period to firm up the MOU into an actual binding commercial contract.
Okay, so can you give us any detail on what the key items you're negotiating on are?
Martin, you're muted again, I think. Martin, we can't hear anything.
Sorry. I was telling you that the negotiation would be around the actual split between different products. The testing of the Naranja product, the Olaroz product, has already been tested. My line is not working properly then, Neil, maybe. If you can answer that for me, please. Can you hear me?
Yes.
Yeah, okay, thank you. And maybe just the assumptions
Hello,
around...
can you hear me? Neil, why don't you answer? My line is not working properly, seems to be.
That's okay, Martin. I'll pick up the questions. Levi, so are you good with Martin's response on the one before?
I guess so. And maybe, Neil, just talk me through the assumptions behind how much runway you have if prices don't recover.
Well, the runways probably, we've looked at what we did with the stress testing, Levi, was we looked at extended low price as well as increases in capex for an extended period. If you look at that sources and uses of funds is a little over $100 million, that would get us through for at least about 3 years in really a real downside case of long extended weak pricing and increases in capex due to COVID. So we stress that heavily. So basically, those were the main assumptions, and we looked out to 3 years, and that was it.
Thank you. That does conclude the question and answer session. I'll now hand back to Neil for closing remarks.
Martin, do you want closing remarks, or do you want close it out? Well, thank you very much to everyone for listening in and calling in.
Line's not working properly here, Neil, if you can do that.
No problem. Thank you again all for calling in. I think we've achieved a milestone now with a very large contract. We do have other contracts in place. We expect to be sold out possibly beginning 2023 financial year, certainly by 2025 with the other contracts we have, plus this PPES. It's a key milestone, what we're raising now, just in terms of setting us up for the future in these uncertain times. And we still remain big believers in lithium EVs and the future of it. So thank you all for attending the call, and look forward to, well, I can't say a roadshow because I think we're all sitting at home, a lot of us. But we'll talk soon. Thank you.